Hello, I'm Angie Austin with Oil and Gas 360, and we are here at EnerCom's 2016 Oil and Gas Conference, the 21st year of the conference. And we're joined by Art Hogan, and Art is with Wunderlich Securities, and he is a Director of Equity Research and a Chief Market Strategist. Hello, Art.
Hey, thanks so much for having me today.
All right, so let's talk a little bit about the main economic drivers affecting the oil and gas industry today, and specifically today, if you want to talk about that as well, what happened?
Yeah, it's interesting. So we'd like to believe that supply and demand is the only thing that drives energy prices, and if that were only true, then we'd be in a much stabler place than we are. What's happening right now, and today is no different than the last week or so, energy prices have caught a bid, and that conversation circles around the possibility of, after 2 years, OPEC doing something about production, right? So, remember back 2 years ago when we had a surprise by OPEC and they weren't going to do anything about production, and they really haven't changed, but every time we circle around a possible meeting in September now is the new talk, and Saudi Arabia perhaps even bending into this and perhaps even talking to the Soviet Union and trying to do something about production and production freezes. Unfortunately, that's the conversation, and we've heard these before. We'll see what happens. But we get optimistic, and what typically happens in this time frame is people that are short the commodity don't want to be into a meeting. So we're seeing short covering move energy prices up. At the same time, we're in a much better place in terms of the balance of supply and demand. So, over the last 2 years, the swing producer, which had typically been OPEC and Saudi Arabia, has become North America. So our production in North America has come off significantly. That's getting us back into balance. And what's happening this week is really a lot about the conversation around the possibility of a September meeting and perhaps a production freeze. We haven't seen one in 2 years. I don't know if we're going to see one in September, but it's a big part of the conversation this week.
All right, Art. Let's talk about oil and natural gas. Do you think price is driving supply rather than the other way around? And if this is the case, what will that mean for North American E&P companies?
Well, I will tell you this. So the good news is we're seeing stability in energy prices, and that's very important for North American E&P companies. The environment in which we go from 100 to 75 and then 75 to 50 and 50 to 26 as early as last February is not an environment where E&P companies will do anything, right? They find all sorts of ways to cut expenses. They take rigs down. Our rig count in North America is something like 1,900 went down to 400, right? So very slowly, as stability comes back in, as we settle into a $40 to $50 range in WTI, production comes back online. E&P companies actually feel emboldened to step out and have some CapEx. We haven't seen CapEx for 2 years. We've actually seen a reduction in CapEx. That's happening because of stability. It's also happening because North America's gotten much more productive at producing. So we're much more economic at 45 this year than we were last year and the year before. So you can actually look out and see, probably half of the companies that are at this conference will tell you they're economic at the current commodity price, which means we'll very slowly see more production come online. It's not gargantuan. So remember, we peaked at about 1,900 rigs. We got as low as 400. We're back in right around 470. So it's not as though a lot of rigs coming back. But what's important is companies are spending money. They're doing it in a much more productive way.
Right.
They're very smart about it.
Yeah.
It's efficiencies. And the efficiencies has a lot to do with technologies and drilling that were mastered at $100. Right? So you were able to experiment on $100, get better at what you're doing, and become much more productive at $45.
All right, let's talk a little bit about Brexit. What effects are you seeing from Brexit today, and what will the effects be 2 or 3 years from now?
Well, it's interesting. So Brexit was going to be this earth-shattering event, right? And it wasn't predictable. As a matter of fact, everybody predicted that it wouldn't happen. And the near-term effects in the equity markets were pretty abrupt and very short. So the world kept on spinning. We saw the market go down about 6% in 2 days. Since then, we're up about 10% from those lows on the NASDAQ, the S&P, and the Dow. We're seeing a bounce back because the effects of Brexit in its entirety will be mostly felt by the UK. The UK is a very important trade partner to the Eurozone, but it's not a very important trade partner to North America. Now, the longer term effects of Brexit will be if this sets a template. So any of those European countries that aren't enamored with being run out of Brussels with regulations and onerous oversight decide that the Brexit worked, we're going to do the same thing too, and then the Eurozone in and of itself could implode. that's many years down the road. We haven't had another referendum since Brexit. Our biggest concern is contagion. You know, if this works for the UK, does Spain and Portugal and Italy start looking at this as a viable alternative? It hasn't happened yet.
All right, Art, in your opinion, how close is the global oil and gas industry to reaching supply and demand equilibrium?
I think we're very close, and it's interesting because we got there in an unorthodox way. We got there by the swing producer being North America. So our production is off significantly from our peak, and that's really what's brought things down. Now, demand for energy product has continued, but albeit at a slower pace. But we're seeing, global demand growing at, something south of 2%, but something north of 1%. That's great, but we're seeing supply come off globally. So that imbalance probably is something we'll be talking about being in balance in the second half of 17. The difficult thing is in the commodity price, and this is something we never see, there is no price baked into oil for disruption of supply. And we saw that 3 weeks ago or 4 weeks ago. Canadian wildfires, oil goes from $45 to $50 in 2 days. Why is that? Production comes offline. Nigeria, Venezuela, a lot of the hotspots that have difficulty in production, when that production comes offline, there's nothing baked into the price.
Right.
10 years ago, we had a bid. Part of the price of oil was always a fear of disruption of supply. There's none of that now. So as we get closer to equilibrium, any shocks to the production side of things are going to have a much more magnified impact on the commodity price.
All right. Let's talk about the demand side. We'll talk about the latest from China and India. And where is the demand for petroleum and natural gas going to come from 10 years from now?
Well, emerging markets, China, India, the U.S., continues to grow, but not at the kind of pace that we're seeing in China and India. I think that the largest of the increase in demand for hydrocarbons writ large will be from China. So you think about the generational change that China's going through, moving 600 million people from farms into cities.
Yeah.
People that used to walk are riding bikes. They go from riding bikes to riding motorcycles. They actually need electricity. That's the seismic change in demand. Yeah, and that's where the bulk of that change is going to be. At the same time, we're getting a lot more efficient in finding hydrocarbons and bringing them to market, and I think that's going to be a very exciting period of time. And at the same time, we're getting more efficient in our use. So think about the efficiencies and the mileage that you get on your car now,
right,
and the use of alt energy products. So there's going to be a nice combination of things, but there's going to be demand for hydrocarbons over the next 10 years. That's going to, in large part, come from both China and India.
Are you enjoying the conference?
The conference is wonderful. It's one of the best conferences to go to because the combination of corporates and investors in the same room talking about the same thing, you don't really find in any other industry. It's just you can sort of tell that the spirits are good by the conversations you have. It's interesting, and you always learn something new. You find out about some new technology or somebody that's had an amazing new find in some place you've never heard of.
Right.
Well, the most interesting thing to me, though, in this conference is how much more optimistic producers are, and how much more economic they are at a much lower price. At this conference 2 years ago, if someone were to say, I'm economic at $45, they would have been laughed out of the room.
Really?
And fast forward 2 years later with productivity gains in drilling technologies, we've just gotten better at it.
Right.
Makes us more productive, makes us more efficient, makes us more economic. And we're actually being a whole lot smarter as an industry in the places we go to find hydrocarbons. We're not just drilling holes in the ground and hoping for the best.
Right, which is good.
Yeah.
All right, thank you, Art. Art Hogan, again, Wunderlich Securities, a Director of Equity Research and a Chief Market Strategist. And I am Angie Austin with Oil and Gas 360. Thanks for joining us.